Bismillahirrahmanirrahim. This is the second video on incremental analysis. In the first video, we described the concept of incremental analysis. We also identified the relevant cost in accepting an order at a special price and make or buy decision. In this video, we will explain how to use incremental analysis to determine whether to sell or process materials further, cost to be considered in repairing, retaining, or replacing equipment, and how to decide whether to eliminate an unprofitable segment or product or not. Please like, subscribe, and share my channel to search for accounting lessons and hit the notification bell button to alert for the latest video. For all of your questions, comments, and suggestions, please put them in the comment section below. And for webinar and speakership invites, please send me a message at accountingamir@gmail.com, AK for accounting. We hope that this video helps students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. We hope this video helps ACCA, AICPA, CPA, and CMA aspirants. We also hope that this video helps fresh graduates who have joined the companies and want to refresh their learning of incremental analysis. Let us first look into how incremental analysis help to determine whether to sell or process materials further. The sell or process further decision is the choice of selling a product now or processing it further to earn additional revenue. This choice is based on an incremental analysis of whether the additional revenues to be gained will exceed the additional cost to be incurred as part of the additional processing work. Thus, the basic decision rule to sell or process further is process further as long as the incremental revenue from such processing exceeds the incremental processing cost. Let us look into an illustration. Woodmasters Incorporation makes tables. The cost to manufacture an unfinished table is 35. The cost includes direct material 15, direct labor 10, variable manufacturing overhead 6, and fixed manufacturing overhead 4. The selling price per unfinished unit is 50, so the net income is 15. Woodmasters has unused capacity that can be used to finish the tables and sell them at 60 per unit. For a finished table, direct material will increase by 2, so now the direct material cost will be 17 per unit. Direct labor cost will increase by 4, that makes 14. Variable manufacturing overhead cost will be increased by 2.4, so now it will be 8.4. No increase is anticipated in fixed costs, so they remain the same. And the total cost now will be 43.4. And the net income per unit, if we process further, will be 16.6. So our direct material has increased by 2, direct labor has increased by 4. Variable manufacturing overhead has increased by 2.4. There is no change as far as fixed manufacturing overhead is concerned, and our total cost has increased by 8.4. So the net income has increased by 1.6. So it would be advantageous for Woodmasters to process the tables further. The incremental revenue of 10 from the additional processing is 1.6 higher than the incremental processing cost of 8.4. Let us look into another illustration, and before that let me tell you I have put this example in an Excel sheet in case you find difficult to read my handwriting. Easy Does It manufactures unpainted furniture for the do-it-yourself market. It currently sells a child's rocking chair for 25. Production costs are 12, variable, and 8 is fixed. Easy Does It is considering the painting the rocking chair and selling it for 35. Variable cost to paint each chair are expected to be 9. So now the total variable cost per unit will be 21 and fixed costs are expected to be 2. So the fixed cost will be 10 now. And the net income, if we sell unpainted furniture, it will be 5, and if we sell by after processing, the net income will be 4. Our revenue increases by 10, the variable cost increases by 9, the fixed cost increases by 2. So actually our net income decreases by 1. So the analysis indicate that the rocking chair should be sold unpainted because net income per chair will be $1 greater. Let us solve some exercises or on sell or process further. And again this is in an Excel sheet you can see, and we have another illustration now. The company makes unfinished bookcases that it sells for 62. Production costs are 36 variable and 10 fixed. Because it has unused capacity, the company is considering finishing the bookcases and selling them for 70. Variable finishing costs are expected to be 7 per unit. That means now the total variable cost per unit is 43. With no increase in fixed cost, so fixed cost remains the same. So the total cost if we sell unfinished is 46, and this will make a net income of 16. And if we process further, the total cost will be 53 and the net income per unit will be 17. We can see that the revenue will increase by 8, variable cost will increase by 7, there is no increase in the fixed cost, so the total cost is 7 and the net income will be increasing by 1. So the bookcases should be processed further because the incremental revenue exceeds incremental cost by 1 per unit. Let us look into one more exercise, and before that let me tell you I have put this illustration in this Excel sheet as well, and let us make a bit of correction. This should be 7 and this is 0 and the total cost is 7 and the net income is 1. Let us look into another exercise. Stahl Inc. produces 3 separate products from a common process costing 100,000. Each of the product can be sold at a split off point or can be processed further and then sold for a higher price. Shown below are cost and selling price data for a recent period. Sales value at a split off, this is the sales value, and we have 3 products. And the cost to process further is given over here. Sales value after further processing is given here. Determine total net income if all products are sold at split off point at this point. So you can see that the total sales value will be 130,000. And the joint cost is given to us as 100,000. So the net income will be 30,000. Determine total net income if all products are sold after further processing. So after further processing, the total sales value will be 440,000. The joint cost is 100,000 and the additional cost will be 280,000. So the net income will be 60,000. Now, using incremental analysis, determine which product should be sold at a split off point and which should be processed further. So the incremental revenue when we are going to if we sell the incremental revenue, if we sell product 10, it will be incremental will be 130,000. For product 12, the incremental revenue will be 20,000. And for product 14, the incremental revenue will be 160,000. While the incremental cost will be 100,000. $30,000 and 150,000. So the incremental profit or loss for product 10, there is an incremental profit of 30,000. For product 12, there is a loss of 10,000. And for product 14, there is an incremental profit of 10,000. So the company should sell product 10 and 14 should be processed further, and product 12 should be sold at a split off point. Now determine total net income using the result from C and explain why the net income is different from that determined in B. Okay. Now the sales is, if we are going to sell after further processing product 10 and 14, and we will be selling at a split of product 12, so the total sales value will be 420,000. The joint cost is already given to us as 100,000, and there will be an additional cost of 100 and 150, that makes 250. So the net income will be 70,000. So we can see that the net income, if we compare it with C, the net income is 10,000. 70 minus 60, and this is higher in D than in B because product 12 is not processed further, and this has increased the overall profit by 10,000. Next, let us look into how to apply incremental analysis in case of repair, retain, or replace equipment decision. Again, I have put this in an Excel sheet for your convenience in case you find difficult to read my handwriting. For repair, retain, or replace equipment decisions, for such decisions, management needs to decide what would benefit the company over a period of time. Just note that book value of old equipment is not relevant as it is a sunk cost, and we have to compare relevant cost to determine whether it is a cheaper alternative, including any revenue that can be generated based on the alternatives. Let us now solve some illustrations. Jeff Coat Company is considering replacing a factory machine with a new machine. Jeff Coat Company has a factory machine that originally cost 110. It has a balance in accumulated depreciation of 70,000, so its book value is 40,000. It has a remaining useful life of 4 years. The company is considering replacing this machine with a new machine. A new machine is available for 120,000. It is expected to have zero salvage value at the end of its 4 years useful life. If the new machine is acquired, variable manufacturing costs are expected to decrease from 160 to 125, and the old unit could be sold for 5,000. Prepare the incremental analysis for the 4-year period. So the variable cost or the variable manufacturing cost, if we retain for 4 years, will be 160,000 times 4, that is 640,000. If we are retaining the machine, we will not buy the old machine. And if we replace, it is 125 variable cost for 4 years. So that make for each year. So for 4 years, it will be 500,000. And we are going to buy a new machine for 120,000. At the same time, we are going to sell off an old machine for 5,000. So the total cost will be 640,000, and this will be 615,000, because this has to be deducted from the cost. This will be an inflow. So our variable cost is going to decrease by 140,000. If we replace, and we are going to have an addition for the purchase of the cost, our cost will increase by 120,000, and this will decrease our cost when we are selling the old machine for 5,000. So actually the total cost will decrease by 25,000. So the cost will decrease because of selling old machine. So that is the case over here. So in this case, it would be to the company's advantage to replace the equipment, as the total cost will decrease by 25,000, or this will increase our net income by 25,000. Let us look into another exercise, and before that I have put this in an Excel sheet for your convenience. And now the company has a factory machine with a book a cost of 300,000. This machine will have a 5 years useful life with no salvage value. The new machine will value of 90,000 and a remaining useful life of 5 years. It can be sold for 30,000. A new machine is available at a lower annual variable manufacturing cost from 600 to 500. So this is for a period of 5 years. Prepare an analysis showing whether the old machine should be retained or replaced. So the variable cost for 5 years, if we retain, will be 600 times 5, that is 3 million. We are not going to buy the machine if we are retaining. We are not going to sell the old machine if we are retaining. So the total cost will be 3 million. If we replace, the variable cost will be 500 each year. So for 5 years, it makes 2,500,000. If we buy the new machine, it is going to cost us 300,000. and we can sell the old machine for 30,000. That means our variable cost is going to decrease by 500,000. Our new machine will increase our cost by 300,000, and when we are selling, obviously it is going to decrease our cost by 30,000. So over here, if we replace, the total will be 502,770,000. And we can see that this will be 230,000. So the old factory machine should be replaced, because it will, if we replace it with a new equipment, it will reduce our cost by 230,000. Let us look into one more exercise, and once again I have put this in an Excel sheet for your better understanding. And let us look into an exercise. Johnson Enterprise uses a computer to handle its sales invoice. Lately, business has been so good that it takes an extra 3 hours per night plus every third Saturday to keep up the volume of sales invoices. Management is considering updating its computer with a faster model that would eliminate all of the overtime processing. So we have the current machine, and we have a new machine proposal. If sold now, the current machine would have a salvage value of 600. If operated for the remainder of its useful life, the current machine would have a zero salvage value. The new machine is expected to have zero salvage value after 5 years, should the current machine be replaced. So the annual operating cost, if we are going to retain, is 25 for 5 years. That makes 125,000. We are not going to buy the machine. If we are retaining, there is nothing like salvage value. So the total is 125,000. If we replace the equipment, the cost will be 20,000 each year. So that makes 100,000. The new machine is going to cost us 25,000. And we are going to realize 6,000 by selling the old machine. So our operating cost is going to decrease by 25,000. There will be an increase in our cost of buying the new machine by 25,000, and when we sell the old machine, it will reduce our cost by 6,000. So our cost is going to decrease by 6,000. So the current machine should be replaced, and the incremental analysis shows that the net income for the 5 years period will be 6,000 higher by replacing the current machine. Finally, let us look into how to apply incremental analysis in case of eliminating an unprofitable segment of product decision. Again, I have put this in an Excel sheet for your convenience, and let us go to eliminating an unprofitable segment. A firm must consider whether to eliminate a particular division or segment if it is not profitable. The decisions are called keep or drop or continue or discontinue decisions. Managers must consider which cost and benefit would change as a result of the decision. Let us look into an illustration. Venus Company manufactures tennis rackets in three models: Pro, Master and Champ. Pro and Master are profitable line, Champ highlighted in red. In the table below operates at a loss. Condensed income statement are as follows. We have the condensed income statement. Prepare an analysis showing whether the company should discontinue Champ brand or not. Assume that 30,000 of the fixed cost applicable to the unprofitable segment are allotted 2/3 to the Pro model and 1/3 to the Master model if the Champ model is eliminated. So let us look into the revised income statement. If we eliminate Champ, the sales for Pro will be the same, 800,000. For Masters, it will be 300,000 and the total will be 1,100,000. The variable cost is 520,000 and 210,000. So the total variable cost will be 730,000. And the contribution margin will be 280,000, sales minus variable cost, and 90,000 and 370,000. The fixed cost for Pro is 80,000, but 2/3 of 30,000 will be allocated to Pro, so that makes 100,000, and 1/3 to Master, so that makes 60,000 now. 280 and this will be 90,000 and this is going to be 60,000 now. So the total is 160,000 and the net income will be 180,000, 30,000 and 210,000. So this is part 1. So at first it looked to us that if we eliminate the Champ racket, our net income will increase from 220 to 240, but however you can see that it has decreased by 10,000. So, and the reason why this has happened is because there is a fixed cost that has to be absorbed by the existing models Pro and Master, and this result can also be verified by the incremental analysis of the Champ racket, and let us see how we do that. If we continue with the Champ racket, the sales is given to us 100,000. The variable cost is 90,000. So the contribution margin is 10,000. Fixed cost is 30. So the net income is actually a loss of 20,000. Now if we eliminate, there is no sales, no variable cost. So the contribution margin will be 0 again. And the fixed cost do not change. It remains the same. So now the sales has decreased by 100,000. Variable cost has decreased by 90,000. So the contribution margin is minus 10,000. No change as far as there is no difference between fixed cost, and the net income now is negative 10,000, and that is what you can see over here as well. So let us look in again. I have put this illustration in an Excel sheet in case you find difficult to read my handwriting. And we will continue with the same illustration, but now we assume Assume the same facts as above except. Now assume that 22,000 of the fixed cost attributed to the champ line can be eliminated. For the champ, the total fixed cost is 30, but from this they say 22 can be eliminated. So let us see how it is going to look like. We are going to, if we continue, we have a sales of 100,000. Variable cost is going to be 90,000. So the contribution margin is 10,000. Fixed cost is 30,000. So the net income is minus 20,000. Sales variables are 0. Our sales and the fixed cost do not, fixed cost now they say is going to 22,000 of the fixed cost can be eliminated. That means now the fixed cost will be 8,000 and not 30,000 as it was before. So our sales is going to decrease by 100,000. Variable cost will decrease by 90,000. So the contribution margin is 10,000 and our fixed cost is decreasing by 22,000. So now our net, there is a net income of 12,000 because fixed cost has decreased. Now in this case you can see that because the company is able to eliminate some of its fixed costs by the eliminating the division, it can increase its net income by 12,000. And this has occurred because 22,000 saving that resulted from the eliminated fixed cost exceeds the 10,000 in lost contribution margin by 12,000. Again, I have put this in an Excel sheet for your convenience. And let us look into another exercise. Lisa Inc. manufactures golf clubs in 3 models. For the year, the Big Bart line has a net loss of 10,000 from sale of 200,000. We have sales of 200,000. And the variable cost is 180,000. And fixed cost, so the contribution margin is 20,000. The fixed cost is 30,000. So there is a loss of 10,000. If the Big Bart line is eliminated, 20,000 a fixed cost will remain. So there will be no sales, no variable cost. So our sales will decrease by 200,000. Variable cost will decrease by 180,000 and the contribution margin will be minus 20,000. The fixed cost will decrease by 10,000 and the total now sales contribution margin profit is going to be minus 10,000. So the Big Bart product line should be continued because 20,000 of contribution margin will not be realized if the line is eliminated. You can see over here that if we this will be negative 20,000. So this amount is greater than 10,000 saving of fixed asset. Let us look into one more exercise. The company operates a small factory in which it manufactures 2 products, C and D. Production and sales results for last year were as follows. Units sold for C and D, selling price per unit, variable cost, fixed cost. For purpose of simplicity, the firm averages total cost over the total number of units of C and D produced and sold. The research department has developed a new product E as a replacement for product D. Market. Market studies show that the company could sell 10,000 units of E next year at a price of 115. The variable cost per unit of E is 40. The introduction of product E will lead to a 10% increase in demand for product C and discontinuation of product D. If the company does not introduce the new product, it expects next year's results to be the same as last year. Should the company introduce product E next year? Explain why or why not and show your calculations. Okay. So first of all, we are going to calculate the margin per unit. Now if the selling price per unit for C is 95 and the variable cost is 50, so the contribution margin per unit is 45. For D it is 75 and 40, so this is 35, and for E it is 115 and the variable cost is 40 again, so the contribution margin is 75. Now the fixed cost is 22 times 900, that is 198,000, and 22 times 20,000, that makes 440,000. So the total is 638,000. So this will be our total fixed cost. Now the units sold for C are 9,000. And for D it is 20,000. The sales revenue will be 9,000 times 95, that is 855,000, and 20,000 times 75, that is 1,500,000. So the total will be 2,355,000. The variable cost is 50 times 9,000, that is 450,000, and this will be 40 times 200, that makes 800,000. So the total is 1,250,000. So the contribution margin is sales minus variable cost. This will be 405,000. This will be 700,000. And this will be 1,105,000. And from this we will subtract the fixed cost of 638. So the net income is 467,000. Now if we eliminate product D and we bring in we work only with C and E, so presently we are selling 9,000, but then the sales of the introduction of product E will lead to a 10% increase in demand of product C. So that will make the total units sold as 9,900. E, they are selling 10,000 units. The sales revenue now will be 990 times 95, that is 940,500, and the variable cost will be 50 times 9,900, that is 495, and this will give us 445,500. And for E, they are selling at a price of 115 each. So 1150, 1,150,000. Variable cost is 40 per unit, that makes 400,000. So the contribution margin will be 750,000. The total sales will be 2,90,500. Total variable cost will be 895,000, and the contribution will be 1,195,500. And this will we will decrease the fixed cost, that is 638,000. So that makes 557,500. So yes, the company should introduce product E as the net profit now is 557, before it was 467. So the net profit will be 90,500 more. So again, I have put this in an Excel sheet for your convenience. And this completes our discussion on second part of incremental analysis. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question regarding this session, then please don't hesitate to ask in the comment box or by email, and inshallah I will reply you back. Thank you so much and happy learning.